friends. Welcome back to the Wall Street Skinny. I'm Jen.
I'm Kristen.
And this is our real estate private equity episode. We've had so many requests for this over the past 2 years. And real estate private equity is something that is extremely topical. We'll get into a lot of the reasons why in the episode itself. But first, before we get into that, we've got tons in the news. We had the Fed on hold earlier this week, which was not a surprise to the markets, but went counter to both the Trump administration and many pundits calling for the Fed to cut rates. We'll talk about kind of why that doesn't necessarily seem appropriate and why they are calling for that. We had an announcement that Millennium is selling stake in itself. Millennium is one of the most successful, largest hedge funds, one of these pod shops, so-called. And we also had the largest acquisition of a basketball team ever in sports history, which plays into a lot of the sports investing podcasts we've done in the past. So lots to talk about here. Kristen, you want to kick us off?
Yeah, I mean, so you had pinged me because you were like, okay, can you explain what exactly is it that, Izzy Englander, who is the founder of Millennium, he's selling out this 15% stake. What does it mean that it's worth $14 billion? What is the valuation? Like, what are you getting and how does that all work? I think that pod shops are things that most people hear about and they're like, oh, I want to go work at a pod shop. Literally last week, there's a whole bunch of articles in the press about the $100 million pay packages that, again, like the Millenniums, the Citadels, the Balyasnys are using to try to lure talent away, comparing it to these massive sports contracts that people sign. And so people are often familiar with them, but I don't think necessarily understand how they differ from your single manager hedge fund. And so I want to quickly go through big picture what the model is for this particular type of company. And then we can just talk about kind of the valuation and then how it compares to a regular single manager hedge fund versus a private equity firm. And by the way, so with Millennium, when we say that it's a multi-manager structure, they have 300 plus, I think it was 320 or something. I might be getting the number a little bit wrong, but they have something like 320 different teams, again, across all different strategies. So they have macro, they have equity long short, they have relative value. So you have all these different strategies. And what the fund does is they lever up. So if you look at something like a Millennium, they manage, call it $75 billion of capital. So they basically take that $75 billion and turn it into, call it $750 billion worth of gross capital that, again, is then given to all these different investment teams. And the thing that makes this very successful is they have very tight risk limits, very centralized controls, and they're highly diversified. And so what that means is that they have incredible returns. I think it's been on a net basis, something like 14% annually. Now, the thing that's different from your single manager hedge funds is that the performance fee nets the expenses to the investment team. So what does that mean? Basically, those $100 million pay packages that you see, XYZ portfolio manager is making, you as the investor, that's going to eat into your return instead of being almost covered in the management fee that most traditional hedge funds that would go towards. So the idea is that if their performance is 20%, all those expenses get passed through to the investor. So on a net basis, you're looking at call it 15%. At the end of the day, though, if we're thinking about, okay, what are you buying into if you're buying into this pod shop? You're actually buying into a slice of the profits. And so you're buying into those fees. So the fees you're paying to a Millennium are, if they have a bad year, you're guaranteed to pay 1% management fee. So 1% on the AUM. So that'll be 1% times $75 billion or $750 million. That's base case scenario. However, if they have, again, the performance, you have to pay a performance fee. And so that's on the revenue side. On the expenses side, I said a lot of those are passed through, but then you have the general expenses. So things related to recruiting and accounting and a lot of the infrastructure, and that's all paid by the management company. And so typically when you're doing comps, you look at the value of the firm relative to some operating performance metric. So in this case, if we were saying, all right, what are the actual cash flows? You have, like I said, the revenues, which again, worst case scenario, you have that management fee of 75 billion times 1%. So that would be something around the order of $750 million, or the performance fee. So if we were to take, for example, 2023, they had a net performance or a net return of 15%. To yield that, they would have had to have an even higher return. So let's call it 20%. So 20% times the $75 billion times the 20%, because they get 20% of the upside. That's something along the order of $2.25 billion. And then you have to obviously haircut that because there are going to be some kind of expenses. So assume we're looking at operating cash flows of 1.125 billion roughly. The valuation we said was like 14 billion. That's what some of these other investors like BlackRock and Peter Schill, who are considering investing, would be buying into, right? So if we look at, again, the valuation, the $14 billion valuation over the 1.125, that's something like a 12 times multiple. Now, that is higher than your traditional hedge fund, which I think historically is something in like the order of 4 to 6 times. Private equity firms tend to trade at higher multiples, so more like, call it, 15 to 20 times. But for a firm like Millennium, they do have a number of features that are attractive. They have longer lockups typically than your traditional hedge fund. It's a blue chip brand, best in class. So it makes sense that you're paying a higher multiple. But I think what's so interesting about this is we've seen a lot of private equity firms go public, and this is not a company going public, but it is a way now for the founder to cash out. All right. So the second thing that happened this week was there was a massive deal in the sports world. And so I think it was actually some finance guy, I probably should have looked up exactly who it was, who bought a majority stake in the Lakers for a $10 billion valuation. And what's crazy about this is, so Jen and I, we had done an episode a while back on Sports Investing 101. And we went through the different ways these different franchises are valued. And the pecking order is basically like football is the best franchise, period, full stop. Then you have basketball, and then you have baseball. But a lot of what you're buying into is like the franchise. And so 65% of the cash flows from buying into, say, a basketball team are at the franchise level, and then call it 35% are local. And so looking at the comps, just to go through the largest and most recent deals, the LA Lakers, right, just announced $10 billion valuation. Celtics was 6.1, both basketball. I mean, the Celtics, people were, floored by that number. I would argue probably the Lakers and the Celtics are probably the two crown jewels of basketball. The two prior record-setting deals were NFL. So that was Washington Commanders in 2023 for $6 billion. And then before that, it was the Denver Broncos in 2022 at $4.7 billion. So we just keep seeing the valuations continue to tick up. And again, at the end of the day, it's not like you're going to continue to mint new basketball teams or baseball teams or football teams. But I still just think that this is insane that we keep having these record-setting, on crazy level, right? Like, it's not just a little bit. No, it's like huge. And also, again, the most recent were two basketball teams where, again, it's like NFL is also seen as this like juggernaut. And
right, were there to be an NFL acquisition, one would imagine that now the records previously set by things like the Washington Commanders, if you were to trade, say, I don't know, like the Kansas City Chiefs or something like that, all of a sudden you would see, I don't know, what's that, a $20 billion valuation now, like based on these comps?
But anyway, so just really interesting. And we will link in the show notes. We have our Sports Investing 101 episode that you can go back and listen to if you want to check that out. We also had a conversation at the end with Eli Manning and David Edelman. And so, Jen, do you want to talk a little bit about
Well, the Fed is boring by comparison. Yeah. The Fed had their regularly scheduled meeting on Wednesday of this current week. And listen, they didn't do anything, right? They stayed on hold. But what got me all riled up was Kristen has expanded my podcast listening universe. I was not really a podcast person, or the things that I listened to were not like newsy and current events based. So now I have to listen to every podcast that Kristen tells me to that's at least not behind a paywall. And I listened to an episode of the All In podcast, but they were talking about a spate of surprisingly good economic data and how, I guess, one of the hosts, Chamath, has his own proprietary model for GDP. And he actually forecast it coming in above what the Atlanta Fed is forecasting. And that's all well and good. I do not build my own proprietary GDP forecasts, so I can neither comment as to whether that is, likely or unlikely. But what confused me a little bit was, in the same breath as talking about how they're expecting growth in the US to exceed expectations, they were calling urgently on the Fed to lower rates. And we've seen this from President Trump as well. He keeps talking about how the Fed is too late. I found this a bit puzzling, given the fact that the Fed's dual mandate is to maximize employment while keeping inflation as close as possible to their 2% target. If you have surprisingly strong growth and strong employment, why do we need the Fed to urgently cut? And what they kept talking about was that a cut in short-term rates would lower borrowing costs for the Treasury. That is a monetary solution to a fiscal problem. The Fed's mandate has nothing to do with the budget deficit, has nothing to do with how the Treasury funds itself. That is a fiscal problem. And so when rates were cut to zero after the global financial crisis, and again, when we had COVID in 2020, what the Treasury did not do was issue massive amounts of debt in the 10, 20, and 30-year bucket, what we call terming out their debt. They could have done so, although easier said than done, right? That puts upward pressure on long-term rates when you're increasing supply there. And they may have been concerned about the effects. They may have been lulled into a lower for longer or lower forever mentality. They may have overlearned the lessons of Japan. I really don't know why they didn't decide to term out their debt. That's neither here nor there. The bottom line is they didn't. So we have massive amounts of short-term debt that is now maturing and rolling off and needs to be refinanced at higher rates because we are in a higher rate environment now. The solution that they proposed is simply for the Fed to cut rates, thereby making it less expensive for the Treasury to borrow money. And they were on this particular podcast estimating something like $300 billion in savings to the Treasury if the Fed were to suddenly cut rates by 100 basis points. Okay, that's all well and good. And that would maybe provide some kind of temporary relief for the next 2 years. But the problem that we've gotten ourselves into is a lack of fiscal discipline. This has nothing to do with monetary policy. And I would argue that the two need to be separate. We did a whole long deep dive into how one hedge fund broke the Bank of England and how important it is for a country's central bank to maintain its independence. And you can argue that, like, okay, well, like, that's good in theory, but that isn't serving the best interests of the American people. I just personally disagree. I think that monetary policy arm needs to be independent and needs to be protecting that dual mandate, or you open a Pandora's box, if you will, that you can't necessarily close if you were asking the Federal Reserve to bend so deeply to political whims. I would argue that actually the Federal Reserve should not have cut rates 50 basis points last fall. I do not think that was, oh, well, we have the early markers of a recession when inflation was through the roof and we cut rates. We surprised the market with how deeply we cut rates. That was a mistake. I think the Fed learned from that mistake and is very closely guarding what chips they have or what tools they have so that if there is definitive information in either direction, they're either looking for a big slowdown in growth, a big change in unemployment, or a big spike in inflation. That's going to dictate how they move. Where we are right now, we're in a period of massive uncertainty. Everyone acts like the news about the tariffs is yesterday's news. It's not. This has not fully played out. We still don't know what a lot of these trade deals, if any, are going to look like.
And I was also saying, I mean, like, I'm not sure how much, because I mean, you and I had talked about the fact that we did pull purchases forward because of these tariff expectations. And so I wouldn't be surprised if, like, is part of the GDP good because of some of that? Is, by the way, the lack of inflation because, again, the tariffs haven't come through? Like, there's so many questions that, to your point, we just got to wait and see what the data is. So why the hell would you cut now? Like, it doesn't, I'm like, it makes no sense.
There is, just based on the simple dual mandate that the Fed has, I see nothing compelling to argue in either direction. Now, the Fed's preferred measures of inflation also, remember, are deeply disconnected from what you and I experience. I feel a measured change in my day-to-day spending habits. Everything feels so much more expensive, kind of all of a sudden, in terms of going to the grocery store, in terms of everything. I mean, we've just had a big spike in gas. Obviously, oil prices, right? We know why that's going on because there's geopolitical disturbances. But I would also say the dollar is down 10% already. Like, if you just look at the Dixie as a measure of that, it's down something like 10% already year over year, or since the beginning of the year, I should say.
Yeah.
If you cut rates, all else being equal, that should lead to a weaker dollar. I understand that if you are trying to make us into a nation of exporters, that's part of your plan. But I don't know that that's necessarily what's best for the economic health of our country. So I don't see a compelling reason to cut. And I think that we need to be reminded of what the Fed's actual job is time and time again. It cannot be stated enough because I think everyone has been lulled into this. Well, the Fed can just go to zero. The Fed can just go to zero. The cautionary tales that we were told in 2008 haven't lost their relevance and haven't lost their meaning. We are now paying the price for a lot of the lack of fiscal discipline over the last 15, 20 years. So we need change at the fiscal level, not at the monetary policy level, to solve these problems in a real meaningful way. Otherwise, we're just kicking the can further down the road. And I think to the detriment of the economic health of our country. So that was my
Amen.
That was my rebuttal to that thesis. And I do not have access to the same proprietary economic models that these guys have. I'm sure they are operating on much higher levels, but I would just urge restraint when it comes to trying to pressure the Fed. When Powell's term is up, we may see someone who is put into the role who simply does start doing these things. That would be very distressing to me as a watcher of the Fed. I'd heard that we were floating Scott Bessent's name for it. Scott Bessent cannot be both the head of the Treasury and the Fed, or I think he should not be both. I mean, there's probably a world in which he can be both. I would not advise that, but as someone who was central to the undoing of the Bank of England, I think no one understands better than he the importance of a central bank's independence and credibility.
Yeah, love it.
So with that, let's talk about real estate private equity. We are bringing on a woman named Lauren Hochfelder today. She's a managing director at Morgan Stanley, and she is the co-chief executive officer of Morgan Stanley Real Estate Investing, MSREI. She's the head of MSREI Americas. She has been at the firm for the better part of 20 years, or maybe closer to a quarter of a century. And so we've got a lot to talk about today when it comes to valuations, when it comes to the lifestyle, when it comes to the type of analyses that real estate private equity investors are doing, the career path, and what's going on in the market right now. So it's just, this is a foundational 101 level episode that anyone who is interested in real estate investing from that kind of private capital standpoint needs to listen to and needs to understand. So
awesome.
Let's bring her on. We are joined today by Lauren Hochfelder, who is a managing director, and she is the co-CEO of global real estate investing at Morgan Stanley. She is also the head of the Americas division. And Lauren, we are so excited to have you on today to talk about real estate investing, which we've touched on in a number of different ways here, but we haven't talked about it more at the institutional level. And it's something I'm really, really excited to understand and discuss with you. So what we're going to get into today is we're going to talk about what is real estate investing kind of beyond what we think about in terms of like buying a house and renting it out, or even like what we talked about with David Edelman in terms of multifamily and campus apartments and things like that. We really want to understand why it's an attractive asset class. Who are the investors that it's right for? Who is it not right for? What do the investment vehicles look like themselves from a cash flow perspective? How does it fit into a broader portfolio? And what are the market forces that real estate investments are sensitive to? We're going to talk about how you actually model and value those investments for all of you who are thinking about potentially pursuing a career in investing. This is a huge vertical of the investing world that very few people understand. There's a lot of similarities and overlap to how we talk about valuing companies, but there's a lot of differences as well. We'll talk about current market trends, and we're also going to talk about what the career path looks like for those of you who might be curious about maybe following in Lauren's footsteps. So Lauren, thank you so much for joining us. I'd love it if you could share a little bit about your background and how you got started in finance.
Sure. Well, it's great to be with you both, so thank you. So I started in finance, I think actually perhaps similarly to how each of you started in finance, which is as an analyst here at Morgan Stanley. So I joined in 2000 as an investment banking analyst and thought I'd be here for 2 or 3 years, then back to school or on to something else. And 25 years later, here I am. So I started in investment banking. And at that time, our real estate private equity business was housed within investment banking. So as an analyst, I worked on both public market transactions, IPOs, M&A, et cetera, as well as investing in real estate, and pretty quickly figured out that I was drawn to the investing side and stuck with it.
Oh, that's fantastic. We very rarely get to share the stories of people who didn't necessarily stick with the 2 to 3 year analyst track. And it's one of the things that for someone like me from the sales and trading side, there are so many lifers on that side of the business, and it's really refreshing to see a lifer kind of on the other side of the business as well.
I want to actually just jump in and say one other thing, which is back then it was a little bit less common because you oftentimes had to be forced out to go to business school. So like Morgan Stanley had a program called ACP for Accelerated Career Path, where you would have to be like a superstar analyst who would apply to like get accepted to then become an associate. Now, I'm assuming that's a little bit easier. And actually, you can correct me if I'm wrong, but I just wanted to add that color that, again, it used to be that the bank forced you out to go to business school and then would like have you come back after.
Oh my God. I so remember my celebratory dinner at Peter Luger's when I, got through the ACP process. So yes, that's a fun trip down memory lane. We do still encourage people now to stay in. I think there's a recognition that certainly on the investing side of the business, staying active in the markets has a lot of benefit, at least as much, if not more, than going back to business school.
So what is real estate private equity, and how is it different from all the other types of private equity we talk about? How is it different from the good old fashioned LBO that we talk about, the venture capital, the growth equity? What is it, and why is it so sexy?
Sure. So look, real estate, sort of start with what real estate is. Real estate are the hard assets, the sort of physical infrastructure in which we all operate our lives, right? It's where we live, where we work, how we want to purchase goods, whether online or in store. It is really underlies everything we do in the public sector and the private sector, et cetera. So it's homes, malls, industrial warehouses, it's student housing assets like you referenced earlier, office buildings like I'm standing in now. So it is all of that. And I think one of the things that makes real estate so exciting is it is an asset class that I think is so tangible, so easy to understand, because the drivers of it are so fundamental to how we all spend our days.
Talk to us about first principles. When you're thinking about who are the big players in the space, who's investing in real estate, globally speaking, and how do we then break it down in terms of different ways of approaching the market?
Sure. So when I started back in 2000, I'd say institutional real estate investing was predominated by US pension funds in particular. So it was the large US pension funds, corporate and public, who invested in real estate. And a lot of that, sort of 3/4 of that, was essentially office buildings and malls. So if you invested in institutional real estate, it basically meant that you owned office buildings and large malls. And today that is actually completely inverted in many ways. Firstly, the capital markets have become much broader. So over the course of the last 25 years, the institutional investor base that's invested in real estate has broadened both geographically and in terms of type of investor. So you have tons of European investors, Asian investors, Middle Eastern investors. You have different types of institutions. So insurance companies, sovereign wealth funds, et cetera. And then more recently, you've seen the rise of the democratization of real estate funds, as you've seen with other types of private alternatives. So the sort of rise of individual investors being able to access private real estate in a way that's quite similar to how institutions have done it. And I think that's very, very exciting as a trend.
So one little thing that I did want to just touch on, because you had mentioned this at the very beginning about how when you started, the investing side was lumped in with investment banking. What did the split look like? And was it because of the 2008 financial crisis that it had to almost like get walled off? And I'm curious then, if you're now sitting on more of the investing side, are most of your investors, are they like the institutional investors? Is it like almost like that 2 and 20 model? Is it more REITs? Like, I'm just kind of trying to wrap my head around sort of like what the model was and why there was the split, how it evolved, and who your clients are or who the investors are in the products that you're putting together.
Sure. No, look, the history of our business actually is almost a mini version of the history of the industry overall. So our business was started in the early 90s out of the S&L crisis, out of the savings and loan crisis. I joined in 2000. The reason it started in investment banking is really because at that time, the firm was helping its institutional clients gain exposure to private real estate as an asset class. So it basically started advising a couple of large US pensions. Over time, that grew into discretionary funds. And really, Morgan Stanley Real Estate was one of the first global private real estate investors that did this. So we were really at the very forefront of the industry. And at that time, what it was a series of closed-end opportunistic funds. Raise the capital, invest it, return it, or buy it, fix it, sell it. And
Yep.
all of that was targeting, call it 20% types of returns. We still have those funds, we still have those closed-end opportunistic funds, but over time, our business and frankly the industry overall brought in to invest different types of capital. So institutional core funds, for example, have risen as a very substantial part of the industry, meaning rather than sort of buy it, fix it, sell it, its own really fortress quality real estate assets through cycles. So benefit in terms of both current income and appreciation in terms of driving total return. And so through that period, you've seen the proliferation of different strategies, both within our business and the industry overall. And then, in terms of investor base, it's again been all of the types of institutional clients that I referenced, so sovereign wealth funds, pension funds, insurance companies, et cetera. That is the vast majority of our client base, the sort of most sophisticated institutions in the world.
Yeah.
But we do now have more recently strategies that focus on individual investors. And that's particularly exciting because frankly, there are so many benefits to individual investors of having this access. So to be able to have purpose-built structures that cater to that investor base is exciting.
And one quick follow-up, I'm curious about just like the liquidity and the lockup, because you're buying obviously investments that are not liquid. And so I assume similar to traditional private equity, is there longer lockups, or like what is that structure, or does it vary?
So for the closed-end funds, they're largely akin to sort of traditional corporate private equity. So you have a particular number of years in your investment period. And so call it a 4-year investment period, 10-year fund life. And capital is returned as it's returned on the back end through asset dispositions. The open-ended funds generally have quarterly liquidity. So we'll refer to them as semi-liquid, meaning you can redeem a certain amount of your capital on a quarterly basis. So it's really a way of creating some degree or a reasonable degree of liquidity within an, as you said, a sort of otherwise less liquid asset class.
And so thinking about the structure of the investment portfolios for the typical client, ranging from a pension fund to an insurance company to now a retail wealth client, right? Where does real estate typically fall in terms of that allocation, both in terms of, the total size of the portfolio, but also what is it a diversification away from? Like, where does it offset other risks, and where is it kind of additive risk in terms of thinking about the asset class philosophically?
Yeah. Well, firstly, real estate, I think it's broadly misunderstood just how large it is as an asset class, right? Of course, we understand it's the physical infrastructure underlying all of our lives, but actually, depending on how you measure, you could argue it's the third largest asset class after, equity and fixed income.
Yeah, we actually have a 101 on the GSEs coming up with someone from Fannie Mae. And quite literally the mortgage market, the mortgage market itself is the third largest securities market within fixed income world. So, I mean, it totally makes sense.
It is. And I think the other sort of misconception is that it's all one thing, right? People talk about real estate as though it's sort of, what's the price of real estate? Like, what's the price of oil today? And actually real estate is the umbrella that describes a whole host of different types of asset classes and sectors, et cetera. But I think in terms of what role real estate plays in a portfolio, number one, it has this great combination of current cash flow and appreciation, which if you think about equities and fixed income, you generally think of equities as appreciation oriented, fixed income as cash flow oriented. And real estate can really deliver both. I think secondly, it is one of the most powerful inflation hedges. And that's certainly something that is, I think, particularly front of mind for many investors.
We've actually never broken this down for our listeners. We've always kind of talked about it as being the theory. Why is owning real assets a hedge for inflation?
So it's for a few reasons, but in the most basic sense, cash flows from real estate tend to grow faster than inflation. So cash flows from real estate tend to be pretty correlated with GDP growth. So you think about, if you rent an apartment, unfortunately, your rental increases tend to outpace inflation. So your top line is growing in that sense. The other thing is the underlying asset level appreciation Like if you own sort of a bond, at the end, you just get repaid what your principal is. Whereas if you have a hard asset, it is appreciating through that period. And so what you get at the end should be a higher asset value that will, in essence, hedge you against inflation.
Thank you. Okay, so back to the original question. Sorry, you were talking about various reasons that you want to own an asset with this dual structure and being an inflation hedge as well. Why else?
So I think in addition, real estate's an asset class that is a good user of leverage, if you will. You referenced the mortgage markets. It's an asset class that can be financed pretty efficiently, which for those of us investing on a levered basis, that tends to be a boon for real estate. But at the end of the day, what we find most interesting about real estate is that it tends to appreciate with more structural trends. So what do I mean? People generally think of real estate as cyclical, and obviously, like every asset class, it has a degree of cyclicality to it. But when you think about what drives real estate, it's those very long-term structural trends. So for example, why have we been heavy investors in industrial real estate? It's not just that we love looking at warehouses on the side of the highway, but we took a very early view that people were transitioning how they buy goods and transitioning from in-store to online. And as we saw people buying more and more of their goods online and demanding them faster and faster, we saw a complete proliferation of those industrial assets that get those goods to our front doors every day. And so it's something very tangible that drives demand that, again, of course, e-commerce sales is going to be somewhat cyclical because it's tied to discretionary spending and consumption generally, et cetera. But the long-term trend of how people are consuming is something that is measurable or that people can underwrite. So that's one example. Another example would be we're heavily investing in senior housing. And, this is a world with lots of uncertainty, and we can sit here and debate what's going to happen with interest rates or tariff policy or whatnot. But what we don't have to debate is that our population is aging. We can actually calculate the number of 80-year-olds in this country, and with that, understand how their housing needs are changing. And so there are these sort of mega trends that ultimately propel demand through cycles that we find particularly attractive. And then I would just say, lastly, I think real estate not only is great from an absolute return standpoint. So if you look over the long run, the returns have really been more akin to equities with what we think is a lower risk profile, a much more durable return, but yet achieving higher absolute returns. But it's also a diversifier because it doesn't behave in the same way that equities or fixed income behaves. Meaning, for example, if you look at 7 of the last 8 S&P downturns, while the S&P went down, real estate values went up. And so really the GFC, I think, was the only time that they both corrected. And in fact, when all was said and done, you had less correction in real estate. So I think that you get that diversification as well.
I have 2 questions. So number one, is a lot of what the people who are working for you doing, are they sitting there and thinking about the investment opportunities, or are you kind of working with almost like a research division within Morgan Stanley or like your economics team to figure out the modeling and picking the actual individual investments? And then number 2, I'm curious how you balance if you're doing investments in Florida with all these hurricanes, and are you maybe also somehow, as a hedge, like investing in cat bonds or whatever? Like, are you hedging it all within that? Or is the view, whoever is the institutional investor, they can sort of figure that part out on their portfolio side? We're just trying to give them exposure to the real estate market.
Yeah, so a lot of great questions in there. So I think for starters, one of the many things I love about real estate is it's this amazing combination of sort of super macro, but very micro. And so to answer the first part of your question, everything we're doing is based on a very sort of thematic macro perspective on what's shifting in the world. That might be how demographics are evolving. It might be how supply chains are shifting. It might be increased digitalization of the world, these sort of super mega trends. So very macro in nature. But we know that real estate is also super local, right? I mean, sort of the corner you're on really matters. And so you can study demographics all you want, but if you aren't really local to the markets in which you invest, you're going to go terribly wrong. And so our business, we have 17 offices in 12 countries. So we're super global in terms of the perspective with which we invest. And so our decision making is all made on a centralized basis. So we're taking the same perspective as we invest around the world, and we're able to generally rotate capital to where we see the best opportunities on a global basis. But yet our local teams on the ground are such sharpshooters. They really understand all of the nuances of what's going on in their respective markets, where you want to be, what tenants are in the market, whether people want to be in small micro apartments in tall buildings, or whether the preferences are more, sort of larger family size apartments or detached homes, et cetera. So it's this amazing kind of marriage of that top down and bottoms up. So that is one of the many things that's so exciting about what we do. And frankly, trend spotting, right? You referenced student housing up front. And I would say purpose-built student housing is a sector that really first evolved here in the US. So some of my first investments that I ever made back in 2000, 2001 were buying student housing projects or building student housing projects. And by the way, they were so much nicer than what I had just lived in for the preceding 4 years. Now we're seeing that really evolve throughout Europe. So we own, for example, some amazing student housing in Barcelona. So you see the different sectors, how they evolve globally across markets. And I'd say that's a very exciting part of our business as well.
And then on the trend spotting theme, we always hear about private equity as the boogeyman when it comes to buying companies and gutting them from the inside with these evil LBOs, right? And cutting costs. But the big boogeyman in real estate in 21, 22 was the private equity firm coming in and buying up the single family development and absolutely exploding prices higher when we had no new production. I live in the Southeast, and this was a major issue here, where we've now seen entire restructurings of HOAs to say no private equity investors, no investors allowed. And that also creates knock-on effect problems down the line, because as you talked about, right, the structure of a real estate investment can look like an equity, can look like a fixed income investment, because at the end of the day, if the price isn't going up, well, you can always rent it out, right? But if you can't rent it out because there are restrictions put in place against that to deter outside investment, it creates quite the pickle for the average American homeowner. I'm curious, there seems to be a huge shift away from that, away from the, big buyouts of these single family homes. Is that consistent with what you're seeing, and why has there been a trend away from that now?
Yeah, look, I would say that is not a space that we really ever played in terms of competing with individual would-be homeowners to buy homes and aggregate large portfolios. It's just not something we ever did. And there are hosts.
Yeah, to be clear, the boogeyman that I'm talking about, the name was not Morgan Stanley.
Yeah. I know what name you're talking about. Yeah.
Context too. I think there's no question that it became a big trend. I would say if you zoom all the way out, we have a housing affordability issue in this country. By the way, that's true in most global markets in which we invest.
You're talking about Europe. I mean,
right. I mean, there's just too little attainable housing, and it's really a pretty profound or existential issue. And my personal view is that the cleanest solution, if you will, is new supply. And so I'd say a good amount of the residential investing we do is actually bringing new supply to the market. So whether that's building fabulous apartment buildings, whether that's building what we call build to rent, but it's essentially communities of individual homes that people can rent. So, you referenced HOAs, think of them as for rent communities where The individual renters get the benefit of having their own home, but yet professional management.
People love those, by the way. Those have just started popping up around here in the greater Charlotte area, and people love them.
As a consumer, I think they're fabulous because you get the benefits of home ownership, but then first of all, you have the flexibility associated with renting and frankly, the greater affordability just given where interest rates are. But you also, in certain instances, get the amenitization. And gosh, that's pretty nice.
There's that. And I think also as condos become increasingly difficult to finance, if you ever want to turn those communities into something that you can sell and liquidate, it makes it much easier if you need an exit from an investment standpoint.
Yeah.
There's a lot of functionality.
This is totally unrelated, but I think Ezra Klein has talked a lot about just like the problem with just building and getting supply online when it comes to housing. And so much of like the NIMBYism where, people within communities don't want the house next door to be torn down. And so it just creates a problem. And that's only scratching the iceberg, or scratching the tip of the iceberg, I should say.
The other sort of related issue is developers always develop to the rearview mirror, right? In every cycle, virtually every market, you develop what you saw people wanted yesterday. And I think what we're finding, if you look at the US, you really have two really large age cohorts. You have the millennials who are growing up and growing out, and the boomers who are growing older. And in both of those instances, those big life changes are shifting what people need in terms of their housing. And what I'd say is you saw, for example, when millennials before sort of peak household formation years, they wanted these small apartment, I'm generalizing, of course, but generally speaking, small apartments in urban centers that were tall buildings and highly amenitized. And it turns out now that they're actually forming families. They're looking for larger format housing, maybe closer to schools, maybe more suburban, et cetera. And so it's a funny dynamic where you have at the very same time massive pockets of oversupply in certain markets, while you have too little, it's like too much of what they wanted yesterday and too little of what they want tomorrow. And so you have these imbalances that are just sort of fascinating because, again, real estate isn't one thing. Even just residential real estate isn't one thing. People have different needs as their lives evolve.
Talk to us about trends in commercial real estate. We have been waiting for the other shoe to drop on kind of urban office spaces for a while. What do you see being the trend there? And what are we not talking about when it comes to commercial that we should be?
Yeah, well, look, I think firstly, I believe we're well past peak in terms of this work from home odyssey. And so if you look at office utilization rates, it's pretty clear that while people test drove working from home during COVID, and it turns out really liked it, we're well past that, right? So New York, I think at its sort of peak COVID level was about 5%, and now we're sort of in the 70s, just to give you a sense. So things have really shifted back.
Are you serious? We went from 5% office utilization to 70% office utilization? Is that what you're saying? Yes. That is a huge trough. Wow.
What was it pre-COVID? Like 2019? Like what was the utilization and how does the 70% compare?
Sure. So there's a lot of noise in the data and a lot of sort of differences in terms of what's been tracked when and how it's tracked. And is it swipes versus cell phone data versus whatever? So it's a little bit hard to sort of cross compare. But I guess maybe the most interesting way to say it is that like take a market like San Francisco that was essentially fully occupied before pre-COVID, right? It was one of the hottest office markets in the world, obviously, big tech and all of these things coupled with supply constraints. So it sort of had everything you'd want. Today, that market is nearly 40% vacant. I think it's 37% vacant. That is stunning. So to have that little sort of utilization, if you will. But what I think is maybe even more interesting is that even in that market that is 37% vacant, in our office assets there, we're getting all-time high rents. And you would say, well, how can that be, right? Like price should be a function of supply and demand. And if you're half vacant, like no way you're getting higher rents. And I think what we're seeing on the ground is a massive consolidation of demand into the best of the best. It's like this small number of assets within given markets become almost like an oasis in the office desert, right? Everybody wants to be in the same buildings, and it becomes sort of a virtuous cycle, if you will. And I think that's really surprising to people. So that's sort of one. I think the second thing about office that people don't really talk about is it's not just these sort of work from home or utilization trends that have been a headwind for office, but a long overdue acknowledgement of how capital intensive office is. And this is sort of more of a US phenomenon, to be clear. But when tenants come into office buildings, generally landlords have to write big checks to do that. They're building out the space to that tenant's liking. They're paying big leasing commissions, et cetera. So we actually pulled back on our US office investing before COVID, not because we were clever enough to foresee work from home as a trend, but because we felt like the true yields in US office were way different from the advertised cap rates. That's different across different global markets. So if you take, for example, Tokyo or Japan generally, in Japan, tenants are paying for their build-out costs. So
I was going to say, this is actually a huge gaping hole in my knowledge. I didn't realize that landlords pay for the build-out costs for their tenants in the US. That was news to me.
Yes, and this is, I think, what's so fascinating is, right, as you know, real estate generally trades on a cap rate basis. The cap rate is just the yield. It's just the inverse of the multiple, if you will. And people generally will talk about cap rates across different asset classes. So a residential asset might trade at a 5 cap and an office asset might trade at a 6 cap, et cetera. But what's different across different sectors and different geographies is how much capital is below the line. And ultimately, as an investor, you want assets that you're taking cash out of, not constantly putting cash back into. Not that you're not constantly improving your asset, but you need to know what your yield is that you're actually collecting.
Yeah, I feel like it's interesting. My husband and I, we still own our New York City apartment. But again, to your point, rents are higher. Unfortunately, you still have HOA fees. And then there's this little problem of like a mortgage. And so if you look at the actual cost of carrying it versus like what the rent is, it's not as attractive as you might think.
One of the dynamics that's actually really interesting about this is there's a particular type of real estate that actually is more insulated, which is net lease real estate.
Let's talk about that.
Net lease is a lease structure where I collect the rent and the tenant pays for all the expenses. So the tenant pays for roof repairs or real estate taxes or insurance expenses, et cetera. And I'd say, look, through cycles, that's a very protective lease structure for landlords. I'd say it's particularly compelling today. So we find net lease real estate very interesting.
I wanted to circle back on, you talked about manufacturing and industrial real estate a little bit. Given what's happening with still the many, many unknowns about trying to bring jobs in manufacturing back to the US, what's your view on how all that's going to play out, given we don't have the infrastructure right now to support the kind of manufacturing that the current administration wants to bring back? Do you think this is going to be a boon for manufacturing real estate? Do you think that this is a head fake? Do you think that tariffs are just going to cause so much of an increase in building costs that, you know, again, talking about how much you're investing into these things, that it's going to explode higher? I'm curious to get your view there.
Yeah, well, it's fascinating. Let's start with this sort of dislocation of the global supply chain didn't start on Liberation Day, right? And frankly, investing around this theme for quite some time, as we've seen companies diversifying where they manufacture their goods and how they get them to the end consumer. And that's obviously a recognition that we're doing a U-turn on globalization. And it's a result of the increased frequency and severity of event-driven supply shocks. So obviously, COVID was an enormous wake-up call when we couldn't get protective gear or chips or our sneakers out of the port of LA or what have you. So that was the original. But since then, you've seen the Panama Canal, the Baltimore Bridge, the Houthi rebels in the Red Sea, like all of these things disrupting the global supply chain. And with that, the infrastructure that's needed by these companies. And so what I would say is tariffs are one more critical proof point of what we already saw companies realizing, which is they need to have options. They simply cannot put all their eggs in one basket. And so what that's doing in terms of on the ground here in the US, in terms of the onshoring story, look, I'd say we were already seeing a certain amount of onshoring, again, before Liberation Day. And I suspect we'll continue to see some of that. I agree with you that a lot of the manufacturing that's being, discussed or bantered about is perhaps less likely to come to fruition. But for onshoring to succeed, it doesn't necessarily need to be, t-shirts, but it can be critical goods, right? It can be more advanced manufacturing. And so that's what we're seeing a lot of, not necessarily, again, since Liberation Day, because right now we're in a period of uncertainty. And what do companies do in periods of uncertainty? They tend to pause and assess the lay of the land. So I think that's what we're seeing today. But you have seen quite a bit of investment in onshoring over the last 5+ years. And I'd say beyond that, it's not just onshoring, right? It's also nearshoring with, for example, Mexico. It's friendshoring. And all of these things impact industrial real estate on a global basis. So, for example, we own a lot of industrial in India. And India is a major beneficiary of shifting of manufacturing from China to India.
Sure.
I'd say that also perhaps surprisingly affects US real estate, because when goods come in from China, they tend to come into the West Coast ports. When they come in from India, they tend to come into the East Coast ports. So you're seeing even a shifting of demand based on what's happening, far, far away, affecting the coasts of the US.
I have a question about deal mechanics. So we talked about how it's an asset class that benefits so much from leverage, but super dumb question. When we talk about typical private equity investments, we talk about how they're financed through series of bank loans, high yield bonds, whatever it may be that's issued, right? When I think about investing in real estate, I think about mortgages. How are you financing these deals? What's the ticket size? Who's participating in these debt issuances and what do they look like? I mean, I think about even like the fly-by-night real estate investors out there getting hard money loans. Is this private credit? What are we talking? Like, what does it really look like at the institutional private equity level?
Yeah, so it depends by region. So if you look at Europe and much of Asia, I'd say it's still predominantly bank-driven lending for real estate. I think the US, what's true in real estate, which is also true probably just across the broader US capital markets, is it's a more dynamic system. So you have, of course, traditional bank lending, whether that's the regional banks or the mega banks, but you also have sort of CMBS, right? So sold off to ultimate bond investors. So you have CMBS and various types of that. You have a real rise in insurance company lending. That's been a sort of major source of capital for real estate. You also have sort of the alternative real estate lender, so debt funds, if you will. And in the same way that you've seen the rise of private credit as a substitute or addition to traditional corporate bank lending, you're seeing that on the real estate side. So you have real estate debt funds that are raising capital from institutional or private investors and then lending it out. And that tends to be a more flexible type of capital for real estate investors. So when people have, for example, more transitional business plans, so I'm going to, buy this building and renovate it and lease it out, that tends to be a type of investment that would lend itself, for example, to, I guess no pun intended, but lend itself to real estate debt funds.
And one quick follow-on question to that, sorry, really quickly. How sticky are interest rates in this space relative to what we think about in terms of the sensitivity of not commercial, but interest rates for the average retail home buyer?
So, base rates are what they are, right? So base rates are a key component to the all-in cost of borrowing. I'd say in terms of the spread component, we've seen it evolve sort of over time. I'd say right now spreads have probably compressed back to pre-Liberation Day levels, for example. So I think maybe the heart of your question is how sensitive is real estate pricing to interest rates? And I'd say it's quite sensitive, but less than people would think. And so generally people will talk about cap rates as a spread to interest rates, which of course, makes sense. You want positive leverage in what you're investing in. But because so much of the value in real estate comes from income growth, it's much less correlated to ultimate asset value than I think people appreciate.
I love that. Thank you. That was what I was getting at, and you understood where I was going with it.
So in traditional private equity, we tend to talk about it as like some multiple of EBITDA. Obviously, you guys are looking at more loan to value. And I was talking to Jen about the fact that I was like shocked that in some parts of the US, like you can put down like 3% and you're levering up 97%. Now that's obviously if you're buying like a house that is not millions of dollars, more of like $50,000 to $100,000 type of a house. What are the traditional loan to value ratios that you guys tend to see in the deals that you're doing? I assume it probably varies by geography, but like in the United States, like if you're doing a big investment in, some multifamily home, like what's traditional loan to value?
Yeah, look, I mean, obviously it varies for a host of reasons, but I'd say 60% is probably kind of a pretty down the fairway execution.
Got it. And then I'm assuming, unlike traditional residential mortgages, you don't get like a 30-year mortgage, or can you get those longer mortgages depending on the type of investment you're doing?
Like from a commercial standpoint, you would generally, 10 years would typically be the longer end of where we see people borrow commercially. But you have every structure, like a very traditional structure would be a 3-year floating rate loan with two one-year extensions. So sort of 3 plus 1 plus 1, if you will. And with transitional assets, you tend to see more floating rate borrowing because it's more efficient. If you complete your business plan, you want to repay early. Whereas with fixed rate, there's just more frictional cost with shifting what your business plan duration looks like.
And what's the average ticket size on these things? Like, what are the average size of the deals that you're doing?
So the other thing that's so amazing about real estate is you can obviously buy like a $2 million asset or a $2 billion asset or a $20 billion company. And it's all sort of within this category. I'd say when I started in the business, a lot of what we did was what we refer to as like wholesale to retail. So we would buy big companies or big portfolios of assets, and we felt like we were receiving better pricing because we were buying in scale. And then we would parcel out the individual assets. Today, I would say in part because you've seen such a rise of mega funds. Actually, I think if you really look at the data, it's not so clear that you're getting a discount for buying in scale. And in fact, in many instances, we see a demonstrable premium for acquisition in scale.
Interesting.
And so where we try to play is really that sweet spot where it's maybe too big for the local guys, but too small for the folks who want to just buy only in multi-billion-dollar tickets. And we find sort of better value today there.
Okay, so pivoting a little bit, we get asked all the time about what does it take to start a career in real estate private equity? What the traditional career path looks like? Does it echo what we see in the typical investment banking to corporate private equity track? Was it different? How is it similar? If you were to prescribe kind of like, all right, dream candidate coming up through the system, what does their path look like, knowing that everyone's path is different and there's lots of little happy accidents along the way at best? And what are the qualities that you're looking for in candidates in terms of their skill sets?
Sure. Look, I think that in many ways, being a real estate investor is similar to being an investor in any space, right? It's the intellectual curiosity, it's the rigor and the discipline and the focus on really understanding what's going to drive outcomes. And so whether you're looking at projecting what you think the cash flows of a business will be over time or the cash flows of a hard asset, there's a lot of similarities in terms of both the actual analytical skills as well as the mindset. And so, yes, with that, we have a lot of folks on our team who were investment banking analysts who come to us after a couple of years in an investment banking program, have super sharp analytical skills, but so much drive to really learn the discipline of investing. So I think that, there's a lot of similarity there. Maybe where real estate can be a little bit different is it crosses so many different disciplines in terms of the ultimate career path, right? So you have people like me who come from more of a traditional financial background, but you have people who are developers, right? Who are literally going out and designing and planning and getting municipal approvals for, and then ultimately constructing the assets. You have architects, you have sort of just a whole sort of array of different careers one can pursue in real estate. And by the way, with that, it's such a dynamic, interesting range of personalities. So one of the things I love about real estate that maybe is a little bit different from other types of private equity is you have the financial world and sort of dynamic capital markets, but you also have the grittiness of like the local developers in every market who are just, again, total local sharpshooters and experts in their very micro market. So it really straddles both worlds.
Is there any cross-pollination between those developers, the kind of like a layperson real estate investor? Is there any path for them to break into kind of the deal team that you're on, or is it all you need to come with this investing pedigree?
I mean, I think it goes both ways. So I think people can be extraordinary investors from either side of the aisle. And sometimes we actually see folks who have been in the real world, so to speak, like have built buildings or who have leased buildings. They may bring things to the table that are even more valuable, because what are we doing when we're underwriting a real estate investment? We're modeling out the cash flows that we think will come from this asset, and sometimes really understanding what will drive those cash flows, because you've lived it and breathed it on the ground, can be wildly beneficial to ultimately helping to value and understand like which assets are likely to outperform.
I guess asking one other sort of tangential, but the same question, the pipeline to working at a mega fund private equity is 2 years. You need to have the offer to be in investment banking, and then you're probably going to need to apply. I mean, last year they were starting to recruit in July, 2 years before people actually hit the desk. So if someone decides, you know what, I want to work at, let's call it like MSIM, I want to do what you are doing, is it they need to, again, do the 2 years of investment banking? And then is there sort of this like rigorous recruiting cycle that people need to like apply? And it's, I don't want to say cutthroat, but like, is that what someone who is going to be an associate, is that the path? Or can people come out of undergrad? Like, do you guys take people directly out of undergrad? Like, what is the process more specifically for, I'm just curious, like with MSIM, how you guys actually recruit talent?
I'll answer for the real estate business. MSIM more broadly is essentially a broad, diversified investment management business, right? So we obviously have real estate and infrastructure and private credit and private equity and, long only, et cetera. And so I think all of the businesses recruit a little bit differently. As to real estate investing, we've historically had some folks come out of college, right? So sort of like me, but I'd say more traditionally, we're hiring people that have a few years of experience, either in investment banking or real estate private equity or sort of adjacent spaces.
Awesome. Well, anything else that we should be thinking about or that you think our listeners should know if they're thinking about considering either a career or want to learn more about investing in the product?
The only thing I'd leave you with is I think real estate is such an exciting asset class. It's a great way for people to get exposure to a whole host of different industries. So if you're investing in life science real estate, you're really understanding a lot about pharma and healthcare investing. If you're investing in, an office building in San Francisco, you have to understand the underlying dynamics in AI or tech that are propelling demand there. If you're investing in industrial, you're, studying the global supply chain. So I think it's such a great way for people who are really intellectually curious about investing to really gain a wide swath of exposure. So I think it's a lot of fun and gives people broad exposure.
Awesome. Well, thank you so much, Lauren. This was an extremely educational, foundational episode for our listeners. This is going straight up there as Real Estate Private Equity 101, which people have been begging us for going on 2 years now. So thank you so much. Is there anywhere that our listeners can follow you or keep up with you? I know you are constantly on the news and interviewing in all these prestigious outlets.
Well, I will tell you, I just joined LinkedIn. Apparently, apparently I was a dinosaur, and thanks to the team here, they taught me how to be modern. So I just joined that, but otherwise, we try to keep our website somewhat current so that people can follow what we're doing on the investing side.
Awesome. We'll share that link in the show notes. Well, thank you so much, Lauren. We really, really appreciate you.
So nice to be here. Thank you so much.